Okay, let's unpack this. The common saying is that to get rich, you've got to take big risks, right?
Hmm.
But what if that's not the whole story? What if the truly wealthy aren't just taking bigger risks, but understand and handle risk in a completely different way than most of us?
Yeah, it's fascinating, actually, when you look into it, how high net worth individuals approach their wealth. Their relationship with risk isn't just about, like, the size of the bet.
Right.
It's the entire framework they use to evaluate it, to
The
manage
exact
it.
date.
It's different.
Exactly. And that's what this deep dive is all about, especially for you, folks who like to really get how things work. We're going to explore how the wealthy think about and, well, deal with financial risk.
Hmm.
We've looked at a whole range of sources, serious financial research, the psychology behind decisions, insights from wealth managers.
Yeah, and even some surprising angles, like from gambling theory and stuff.
Yeah. So our goal here really is to pinpoint the crucial differences. How do the wealthy see and handle risk differently?
Right, we want to get beyond that surface idea of just betting big. What's the mindset? What are the, deliberate strategies they're actually using?
Hopefully this gives you some unexpected insights and maybe more importantly, some useful knowledge.
Yeah, actionable stuff.
Okay, so let's start by questioning what we even mean by risk. When you hear that word financially speaking, what's the first thing that pops into your head?
Well, traditionally, like one source mentioned, risk is often seen as the chance your investment won't do as well as you hoped.
The uncertainty of returns.
Exactly, that variance.
Right, okay, that makes sense on paper. But psychologically, it feels like for most people, risk isn't just about underperformance. It's much more tied to the fear of actually losing money, isn't it?
Precisely. Psychological research, one of the papers we looked at really highlighted this. People tend to be more loss averse than simply variance averse,
I mean,
meaning the pain of a loss feels way stronger, like significantly stronger, than the pleasure of an equivalent gain. Some studies suggest it's like twice as intense even.
oh, that totally rings true. You see it all the time, people rushing to sell winners to lock in profits.
Lock it in quick.
But then they hang on to the losers, hoping they'll bounce back, even when maybe they shouldn't.
Yeah, that's the disposition effect one of the Investing Essentials articles talked about. Selling winners too soon, holding losers too long. It really shows how our gut reaction to potential losses can mess with rational decisions.
And that ultimately hurts long-term growth.
Definitely can.
So, okay, if the average person is often driven by that fear of loss, how might the wealthy define risk differently? What's their main concern?
Well, what's interesting is the perspective from absolute return managers. We saw this in a financial paper. They define risk very directly. It's the probability of actually losing capital, period.
Losing money, full stop.
Exactly, which is quite different from, say, relative return managers. They're often more focused on how an investment does compared to a benchmark, like the S&P 500.
Ah, okay. So tracking risk versus the market index.
Right. So for many wealthy individuals or their managers, the key insight is that avoiding actual losses is the primary risk. And that focus fundamentally shifts their investment priorities compared to someone just trying to beat the market average.
That is a really important distinction. So the goal isn't just keeping up, it's safeguarding the capital itself. That must massively impact how they approach everything.
Absolutely. It
Yeah.
fundamentally shapes their mindset, their strategies.
Yeah.
If your main goal is capital preservation, the kinds of investments you pick, the leverage you use, your whole approach to risk assessment, it's all going to be different.
Which brings us neatly to mindset differences. It can't just be a different definition, right? There must be some core ways the wealthy think about money and investing that set them apart.
For sure. Several sources pointed to some key characteristics. One that kept coming up was discipline.
Discipline, yeah.
Yeah, the habit of sticking to financial plans like a research journal mentioned, and consistently applying sound investment practices. One source called it money habits of millionaires. It's not just having a plan.
It's sticking to it.
It's having the discipline to actually follow through, especially when the market gets choppy.
That makes total sense. It's so easy to get swept up in the hype or the panic. Having that discipline to stay the course must be a huge advantage. What else?
Another really big one is consistently living below their means.
Ah, the classic advice.
But it's crucial. It creates that essential financial cushion, that safety net. As one source put it, it makes your finances extremely resilient to risk. Spending less than you earn gives you flexibility. You can save, invest, handle surprise expenses without everything falling apart.
Right, it reduces that financial pressure that can force bad decisions.
And that cushion probably gives them the psychological breathing room to think more rationally about risk, too.
Yeah.
You're not desperate for every investment to pay off immediately,
Yeah, good point.
which connects directly to another key difference,
Yeah.
a long-term perspective. Wealthy individuals, as another source discussed, tend to focus beyond the short-term market noise. They really leverage the power of compounding over years, decades even. Yeah, resisting that urge for instant gratification that drives so many towards, riskier short-term gambles.
It's building wealth steadily, not get-rich-quick schemes. And you mentioned something about market psychology earlier.
Right. There's some suggestion they might be less prone to what economists call irrational exuberance.
Okay.
They might be less likely to just assume that because the market went up yesterday, it'll go up tomorrow. They seem to have a deeper appreciation for uncertainty, avoiding that overconfidence trap.
Yep.
Believing a bull market lasts forever leaves you really exposed when it eventually turns.
So it's a mix. Financial discipline, that spending buffer, a long-term focus, and a healthy skepticism about trends and maybe their own ability to predict things perfectly.
Exactly. That paints a very different picture than just like a reckless gambler throwing money around.
Totally. And this mindset must inform the specific strategies they use.
It does. They flow naturally from that way of thinking.
Okay, let's dig into those strategies. What are some of the key actions high net worth individuals take to manage risk? And sometimes, embrace it.
Well, one fundamental step, according to the Millionaire Habit source, is getting debt under control and building up a solid emergency fund before diving deep into major investments.
Basics first.
Right. It strengthens their cash flow, provides that safety net, so they aren't forced to sell investments at the worst possible time if something unexpected happens. Build a strong foundation.
Seems basic, but clearly foundational for managing risk well, no matter how much money you have.
Absolutely. And then you see sophisticated risk management becoming just an integral part of their whole wealth management approach.
Mm-hmm.
Various sources stress this. It involves actively identifying potential risks, assessing them, and then figuring out how to mitigate them to protect and grow their wealth. It's proactive, it's ongoing.
So it's not just picking stocks, it's managing the downsides, the whole financial picture.
Exactly. And a critical piece of this is really understanding their own risk tolerance.
How much uncertainty can they handle?
Right. Both emotionally and financially. Knowing that comfort level is essential for picking the right investments and building a portfolio that aligns with their goals and, their sleep at night factor, it's personal.
And risk tolerance isn't static, is it? It can change.
Definitely. It can shift with age, market conditions, life events. And what's really interesting and getting more common in private wealth is the use of asset liability management, or ALM techniques.
ALM. Okay, what's that?
So it's a strategy traditionally used by big institutions like pension funds. One of our PDFs discussed this. Instead of just having a pool of investments, you think about those investments specifically in relation to your future liabilities or goals. Things like retirement income, funding education, major purchases down the line.
Matching assets to future needs.
Precisely. ALM tries to structure the portfolio to meet those specific obligations, considering the timing and the amounts needed. It makes the risk of not meeting those future goals the central focus rather than just short-term market volatility.
That sounds much more tailored than just basic diversification.
Well, diversification is still fundamental, right? Spreading investments across different asset classes helps reduce that unsystematic risk, the risk tied to one specific company or sector.
Okay.
But ALM takes a more holistic view. It aligns the entire investment strategy with specific future needs and obligations, considering the time horizon for each.
That level of planning must make it easier to take on seemingly bigger risks elsewhere, knowing those core future needs are being strategically addressed.
It likely contributes, Knowing the downside is managed allows for more calculated risk-taking in other areas.
What else characterizes their strategic approach? Any other interesting tactics?
Well, one source suggested they might even reframe risk more broadly as uncertainty. And they might actively cultivate comfort with being uncomfortable by taking smaller, calculated risks in different parts of their lives, not just finance.
Like building a risk muscle.
Kind of, yeah. It might build the capacity to handle bigger financial uncertainties more effectively later on. It's about incrementally expanding that comfort zone with the unknown.
So not sudden huge leaps, but gradually getting used to navigating uncertainty.
Exactly. Now, to make this more concrete, let's look at some of the data points and sort of case studies we found in the research.
Yeah, I'm curious how this plays out in reality.
Okay, one interesting point, though maybe indirectly related, came from a paper on investment literacy. They talk about barriers between people and financial institutions.
Hmm.
The takeaway is that just having a deeper understanding of finance itself can really change how you perceive and manage risk.
More financial literacy often leads to more informed, maybe less emotional risk assessments, the more you understand something.
The less scary it seems.
Potentially, yeah. Knowledge can reduce that fear of the unknown.
Makes sense.
Then we found some really fascinating stuff from the world of gambling in one source. The discussion around spread betting, for example.
It showed how risk experts can actually devise entirely new kinds of risky activities, blurring the lines between finance and gambling. The point isn't about gambling per se, but how sophisticated players approach uncertainty and calculated risk. They understand the mechanics, sometimes even creating new ways to manage their exposure. Maybe that mirrors how some wealthy investors approach markets.
That's a really interesting parallel. Understanding the underlying game, whatever it is.
Right. And we also saw how different gambling cultures show different risk preferences, like favoring table games in Macau versus slots in the West. It just highlights how much culture and psychology influence our appetite for risk.
It's not just numbers on a page.
Not at all. And there was this great example from a race course in Delhi. These cutters use small early bets to kind of manipulate the odds
Really?
before placing their larger real bets. It's not random, it's super calculated. They're exploiting tiny inefficiencies based on a deep understanding of how the betting market works there. It's like information arbitrage.
Wow, even in gambling, strategy and information give an edge.
Exactly. Now, shifting gears a bit, one of the economics papers we looked at analyzed how billionaire wealth is created and raised a challenging question. Is all that extreme wealth purely down to individual risk-taking?
Interesting question.
The research suggested that some industries, particularly those with strong links to government or regulation, tend to produce more billionaire wealth. It sparked a debate about whether these huge fortunes are always entirely merited by entrepreneurial risk alone, or if systemic factors play a bigger role sometimes.
That's a really important nuance. It challenges that simple narrative of the lone, bold risk taker earning every penny through sheer daring.
Yeah, and that same paper also mentioned things like monopolies and the automation of knowledge as potential drivers of extreme wealth. Again, complicating that direct link between individual risk and massive fortunes. Sometimes broader economic forces might be more dominant.
So the reality, especially at the very top, seems much more complex than just big risks equals big rewards.
Absolutely. Which brings us to some important final considerations and nuances around risk.
Okay, what else should we keep in mind when thinking about how the wealthy approach risk?
Well, we already touched on financial literacy. Super important. Several sources linked better financial understanding to better planning, better saving habits, and just more effective risk management overall.
And probably helps people be more objective, less swayed by emotion or hype.
Exactly. Psychological biases like being too optimistic or lacking self-control can really derail financial plans and risk-taking, as one journal noted. And it's also crucial to remember risk tolerance isn't fixed. It's influenced by demographics, age, income, gender, as several studies showed. It's very personal, and it changes over time.
Right, no single wealthy person's approach to risk. It's individualized.
And, we have to acknowledge even wealthy people lose money sometimes on investments. A comment on a Reddit thread pointed this out, maybe a bit cheekily.
Oh, yeah.
But the key difference often lies in their diversification. Their overall portfolio is built to withstand individual hits. A single loss usually doesn't cause catastrophic damage. They manage the downside even when chasing upside.
It's about building resilience to the portfolio.
Exactly. And one final really insightful point came from a paper on enterprise risk management. It argued that an organization's appetite for risk isn't just about metrics and numbers.
Oh.
It's a dynamic process shaped deeply by its core values and culture. So even at a large scale, how risk is perceived and managed has this sort of cultural values-based dimension.
That's fascinating. Risk isn't just math, it's also about beliefs and culture.
So, okay, let's try and wrap this up for you. The big takeaway isn't that the wealthy take wilder risks in some purely speculative way.
Right.
It's more that they approach risk with a fundamentally different mindset. It's more sophisticated. They prioritize long-term goals. They cultivate discipline. They use advanced management strategies. A key focus is on really understanding and actively mitigating the downsides, not just placing bigger bets.
It's about being strategic, informed, calculated, not just reckless. And hopefully, by understanding these principles, you, the listener, can start to think about risk more strategically in your own financial life, no matter where you are currently.
Yeah, which leads to a final thought for you to chew on. Given how much our perception of risk is shaped by our own psychology, our culture, everything around us,
Hmm.
how might consciously examining and maybe shifting your own mindset towards risk, perhaps by getting more comfortable with well-considered uncertainties, keeping that long-term focus, how might that unlock new possibilities for your own financial future?
It's about rethinking that fundamental relationship with risk and reward.